Hello everyone. Today's the topic is double entry system. This is the bread and butter of accounting. This is a very important area. If you can get this right down, the accounting is the most easiest and interesting subject for you. So what is double entry system? This in simple double entry system mean every transaction will have at least two impact. So in mathematics, we have something called positives and positive numbers and negative numbers. Likewise, in accounting, we have something called debit and credit. So here, each and every transaction will have a debit impact and a credit impact. So all of these will happen in an account called ledger account. It is also called as a T account. So let's see what are the transactions we can debit and what are the transactions we can credit. This is the format of a T account. So the left hand side of it is called debit side and the right hand side of it is called a credit side. So it is debit side is also we can write debit as D, capital D and a simple R. Credit we can simply write as capital C and simple R. So what we have learned and what we have already know is asset is equal to capital plus liability. Now I'm going to explain debit and credit through this equation. So what I'm going to do here is asset is equal to capital plus liability. This is what we know. I'm going to put a T from the equal sign. If I put a T from the equal sign, asset will come towards my left hand side, which means the debit side of the T, and capital and the liability will come to my right hand side, which is the credit side. So I know there are another two elements in accounting which is called income and expense. I'm going to put those two also into debit and credit side. How will income impact the business? When there is an income will increase the profit and profits will increase the capital. So I'm going to put income in the same side of capital because income will increase the capital. So I'm going to put income on my right hand side, which is the credit side. So what is an expense? Expense will affect the profits, or if it's a loss it will reduce the capital. So I'm going to put expense on the opposite side of the capital, so which means on my left hand side, which is debit side. On my left hand side or the debit side I can see asset and expense. On my right hand side, which means the credit side, I can see capital, liability and income. So it's easy to remember credit, which means CLI. On my debit side, I have AE. It is very important to know. If you can't remember, it's better to by heart it. By now we know asset and expense mean debit, capital, liability and income mean credit. This I'm going to add another thing. This is asset and expense is debit only when it is increasing. Capital, liability and income is credit only when it is increasing. Let's say cash is increasing, we are receiving cash to the business. So cash asset is increasing. Then we can debit the cash. There is an expense. We are paying rent expense. So rent is an expense because expense is increasing, we can debit it. We are taking a bank loan. When you take a bank loan, we have to pay them later. So it is an obligation for us to pay. So liability is increasing, so we can credit the bank loan. When we make a sale, it's an income, so we can credit it. So what will happen when these elements are decreasing? Simply take the reciprocal or the opposite of it. When increasing asset and expense, we write it on the debit side. So when decreasing, we can put it to the credit side. Capital, liability and income, we put it to the credit side when it's increasing. So when it's decreasing, we can put it to the debit side or the left hand side. So the elements in each side will not change, only the side will change. If you know which side to put when it's increasing, so you can take the opposite of it when decreasing. I hope this is very straightforward. So we know capital, liability and income will come on debit side when decreasing or left, or and when asset and expense is decreasing, it will come to the credit side. We will understand this better when we go through a question. Debit does not necessarily mean always increase, and credit does not necessarily mean always decrease. To increase, some accounts are debited and some accounts are credited. Likewise, to decrease, some accounts are debited and some accounts are credited. So this is the summary of what we have learned. Asset increasing mean debit, asset decrease mean credit. Expense increase mean debit, expense decrease mean credit. Capital, liability and income increasing mean credit, decreasing mean debit. So if you can put a T to the equation, it is very easy for you to remember. Now let's go through a question. I have 10 transactions and let's see how we are going to make double entries. Owner invested 200,000. So what is happening when owner invests 200,000, cash is coming to the business. When cash is coming to the business, cash is an asset. Asset is increasing by 200,000. When asset is increasing, we know we have to debit it. So we can go to the cash account. We can go to the cash account and debit 200,000. When owner invests 200,000, owner will also have ownership worth 200,000 toward the business. Cash is increasing. At the same time, ownership is also increasing. So ownership means capital. When a capital increases, we know we have to credit. So we can go to the capital account and credit 200,000. Here asset is increasing and capital is increasing. So we know double entry mean each and every transaction will have at least two entry. So we know one debit and one credit here. Next question. Purchases 50,000. When we are buying, we have to pay 50,000. Cash is going out of the business. Cash is an asset. Asset is reducing here. When asset is reducing, we know it is credit. So we can go to the cash account and credit 50,000. An important point here is in accounting equation, when we are buying and selling, we do a small adjustment to inventory. But when we are making double entry, we will not make any adjustment to the inventory account. Instead, we will make adjustment to purchase when we are buying and sales when we are selling. So there is no account called inventory. Purchase is an expense. Expense increasing mean it is debit. So we can go to the purchase account and debit 50,000. Cash purchase 50,000. It's an expense is increasing by 50,000 and asset is reducing by 50,000. So it's debit and credits are balancing. Paid rent 10,000. When you are paying rent, cash is going out of the business. Cash is an asset. Reduction in asset is, we know it's credit. Cash asset is going out. When reducing, we will credit to the cash account. Rent is an expense. Expense is, we know, increase. When you are paying rent, rent expense is increasing. So expense element is increasing. Increase in expense is always debited. So we can go to the rent expense account and on the debit side we can add 10,000. So debit 10,000 is equal to credit 10,000. It is always ideal to check whether debits and credits are balancing. The total of debit should match the total of credit. Here an expense is increasing and asset is decreasing. Let's move to the fourth question. Cash sales 70,000. When we make a sale, the business will get cash. Cash is coming into the business. When cash is coming into the business, businesses assets will increase. Increase in asset is always debited. So we can go to the cash column and add 70,000 toward on the debit side because increase in asset is debit. Like purchases, we are not making any adjustment to the inventory. So we are making a sale here. So we are not making an adjustment to the inventory. Sale is an income. Because of the sale, income is increasing. Income is increasing by 70,000. So I can go to the sales account and credit 70,000 to it. So debit and credit balances are matching. Next one, credit purchase 80,000. So we are not buying for cash. Instead, we are saying the supplier that we will pay later. Purchase is a expense. So when we are purchasing, expenses will increase. Increasing in expense is always debited. So we can go to purchase account and debit 80,000. At the same time, here cash is not going out of the business. Instead, we have to create a account called creditor, or we can say trade payable. So we can go to the trade payable account, and on the credit side, we can add 80,000. So when there is a debit transaction, the next transaction is always credit. So we know, because that's double entry. When there is a debit, there is always a credit. Like every action has a reaction, every debit has a credit. So 80,000 is matching with 80,000. Next one, owner withdrew money for personal use 10,000. Here they are talking about drawings. So cash is going out of the business. Cash is an asset. When asset is going out, asset is reducing. Reduction in asset is always credited. So we can go to the cash account and credit 10,000. Now, one important point to note down here is generally transactions relating to owner is adjusted in the capital account. But drawings is something we call a specially, we will not adjust it to the capital account. We will create a separate account called drawings and we will adjust it. When owner take money, it is called drawing. When owner is taking money, his capital or his ownership will reduce. So reduction in capital is always debited. So we can go to the drawings account and debit 10,000. So these drawings will be set off against the capital when we are making the balance sheet that we will learn in future. So here capital is reducing and cash is reducing. Seventh transaction, paid salary 20,000. So always it's easy to think from cash perspective. Cash is going out of the business. Cash is an asset account. So 20,000 worth asset is going out of the business. So reduction in cash is always credited. So we can go to the cash account and credit 20,000. So what is salary? Salary is an expense. So when we are paying salary, expenses will increase. So increase in expense is always debited. So we can go to the salary account and debit 20,000. So debit 20,000 is balancing with the credit 20,000. So here expense is increasing and asset is decreasing. Eighth transaction, obtained a bank loan for 200,000. When we take a bank loan, the business will receive money. So which means cash will increase by 200,000. When cash is increasing, cash is an asset. When asset is increasing, it is always debited. So we can go to the cash account and debit 200,000. When you take a bank loan, cash will increase. At the same time, the liability will also increase because it's our obligation to settle the bank. So obligation mean liability. So increase liability is increasing here. Increasing in liability is always credited. So we can go to the bank loan account and credit 200,000. So here asset is increasing and the liability is increasing. Next one, invested in a fixed deposit 10,000. When we are investing, we will take money from our business and we will go to a bank and put it into a fixed deposit account. So when we take money and go to the bank, cash is going out of the business. Cash is an asset. Reduction in asset is always credit. So we can go to the cash account and credit 10,000. What is fixed deposit? fixed deposit is also an asset. It is called as a non-current asset because we have to maintain that deposit for more than 1 year. So here cash asset is decreasing and fixed deposit asset is increasing. Because asset increasing, we can go to fixed deposit asset and debit 10,000. So reduction in asset and increasing in asset. So net impact is 0. Debit 10,000, credit 10,000. The last transaction is credit sale. When we make a cash sale, we will receive money. Here we are not receiving cash. Instead, we will have a debtor balance or trade receivable balance. So trade receivable or debtor is an asset. It's a current asset. So we can go to debtor account and debit 60,000 because of the sale, our debtor asset is increasing by 60,000. At the same time, if you take sales, sales mean an income. So increasing in income is always credited. So we can go to our sales account and credit 60,000. Here the transaction debit 60,000, credit 60,000 is balancing. So we know increase in asset and increase in income. So if the important point here is to know what accounts will increase and when. That is the key. So I'm just summarizing again. Increasing in asset and expense is always debited. Increase in capital, liability and income is always credited. And when decreasing, we take the opposite of it. So decrease in asset and expense is credit. Decrease in capital, liability and income is debit. So if you have any doubts or clarification, please comment below. Thank you very much. Drawing is a capital.